So we've got to look at the numbers. Growing very fast on the top line, but at a slower pace, 200% 2 years ago, 100% rate of revenue growth last year, and the loss is widening. So what does that mean for the prospects of getting this IPO away? People be able to look past that?
Yeah, I mean, look, you've got a lot of funds already invested in Lyft. You've got your folks like Fidelity, your Senator Investor Group. They're already main investors. And I think the key here is really, do those big funds want to stay in Lyft? And do they want to continue hold on in terms of being buy and hold investors? Or do they want to get out at the IPO? I think that's going to be the biggest key here, is whether or not those companies want to continue to hold on. You've also got them giving a bunch of shares away to their drivers. How does that play out, and where do those shares go? So I think that's really the biggest question right now.
Also, this dual-class share structure, again, right. Which is sort of the norm for these big tech companies. But a couple of years have passed since the last couple. There's been corporate governance questions. Do you think investors mind about that, or once again, the founders keep control of the voting rights?
Look, I think we've kind of entered a period where investors don't mind a lot. There was a lot of things that you could put past investors right now, and they'll say, oh, you know what, okay, this company's growing. I don't want to miss out. I don't want to miss the boat. I can look past your dual share classes. I can look past the fact that you're losing almost $1 billion last year. I just want to get on the growth train because this thing is going and leaving the station. I don't want to miss out.
Now, in general, Dion, it doesn't seem as if this is an overheated IPO market by any stretch. Obviously, it's been kind of quiet. But with Lyft and Uber coming, I wonder if it's going to act as a little bit of a test of investors' appetite for these businesses that are going to be burning capital for the foreseeable future. In other words, yeah, it's an amazing model in terms of the business and getting consumers interested, but they haven't yet been able to figure out exactly the economics of it in a sustainable way without big subsidies.
Yeah, well, look, Facebook was the first company that really came out, and the model was just grow, baby, grow. You know what I mean? As long as you grow, the people.
But they already were profitable.
They were profitable, and now you're looking at sort of the next phase, which is these companies like Lyft, like Uber, that are just losing hundreds of millions. I think this is probably the biggest losses for a company ever coming public to market like this. And I think the reaction is going to be very interesting to watch. But like I said, I don't see why investors would want to miss the boat here. I think right now it's all about FOMO. It's all about wanting to get on. You look at a company like Tesla that's still burning through cash to this day. They were profitable, now they're not. Or they were making money, now they're not. And investors still are getting paid with Tesla stock. So again, don't miss the boat, I think, is the thought process.
I mean, I would view it a little bit differently, having met with these investors many times over my career. If you think about what's going on in the auto industry more broadly, we've gone from combustion, automobile engines to electronic vehicles and ride sharing. These are secular themes that people would expect to carry on for decades, right? Yeah. So how do you get exposure to that thesis? Well, it's expensive right now, so you're going to buy companies that are losing money. But I would expect that the, T. Rowe's and capital groups and all that really have these long-term time horizons are going to be willing to have some degree of exposure into these themes. And the only way to do it is through these types of companies.
And Barry, to your point, one of the biggest bull cases for both Uber and Lyft is the concept of autonomous driving in the future, because they strip out their biggest cost, which is the driver.
Exactly. I mean, when you think about this whole auto cycle, it's really interesting because we go into the next contraction and we come out of it, and generally those contractions cause disruption that get people to change their behavior. So people, just might not be 2 cars or 3 cars like in my driveway, going forward.
I think it's important to say, though, right now, these autonomous vehicles are years and years and years away. It's not coming in 2 years, not 3, not 5. This is way down the road. And I think investors, like you said, have to take a long-term thesis. And I think that's part of the long-term bull case.
It's also interesting for a Lyft or an Uber who has to come and tell a story in the IPO, right?
Yeah.
Especially when drivers are their core constituency, arguably, and they're giving them stock. And you have to say, well, they're just kind of this transitional phase, these drivers, and then we're just going to be this autonomous network.
Yeah, well, hold on to that stock, baby, if you get it.
Exactly.
Dion, what's your take on where the valuation, the overall market capitalization for the company might end up? What are we hearing?
Right now, there are calls for $20 to $25 billion. It'll be interesting to see. I see no reason why they couldn't raise that. Like I said, we're just in this FOMO moment here, where it doesn't matter if you're losing money. It doesn't matter if you've got a case for making money in the future. Lyft has even come out and said to investors, hey, we don't really have a plan in the future to make money consistently on a regular basis, but we'll figure that out. And look, as long as investors are hungry and they want the next big hot thing, they're going to buy in.